Good morning, everybody. Hi. All right. It's a beautiful Saturday morning.
Good morning.
Morning to all.
Morning, everyone.
Awesome. All right. Okay. Thank you, everyone, for joining us. Let's just give us another 1 to 2 minutes for attendees who are still joining in. Right. Awesome. Okay. Right. Right. Let me share my screen. Okay. How is everybody feeling today? Okay, the audiences. Okay. Good morning, everybody. Welcome to our Global Mid-Year Market Outlook 2021. Right. So this we are already in the blink of an eye. We are already in the end of July right now. So half a year has actually passed us, and it's been close to 1.5 years, close to since the pandemic has actually started. Right. So hope everybody is doing well today, and thank you for joining us for this summit on a Saturday morning. And this summit is jointly organized by Mumu, powered by Futu, and also Investing Note as well. All right. Before I start, a introduction of myself. I'm Ethan Ho, Chief Operating Officer at Investing Note. All right. So today, I will be the moderator for this keynote panel discussion. Right. Joining us, we have a couple of power-packed speakers for today. All right. Okay, let me do a quick introduction of the speakers. Right. So let's start off with Adrian Chiu. Right. Adrian Chiu is the Vice President of Sales and Product Strategy, Southeast Asia at CSOP Asset Management. At CSOP Asset Management, Adrian oversees ETF investment solutions for brokers, wealth managers, and family offices in Singapore. Adrian is also part of a team that is responsible for developing sales strategies and strategic partnerships with institutions in Southeast Asia. Adrian, you want to say hi?
Thank you, Ethan, for the kind introduction. Thank you all the panelists and the audience joining us today. I get my first dose of vaccine already, yes.
Oh, I haven't yet. Mine's tomorrow.
Got it.
Cool.
Yep.
Next up, we have Mr. Gavin Chia, Managing Director of Futu Singapore. As the Managing Director of Futu Singapore, which is a subsidiary of the NASDAQ listed Futu Holdings Limited, Gavin Chia actually leads the team in Singapore to grow the Futu footprint through its intuitive and technology-driven Mumu trading platform, which provides clients with an enhanced and seamless overall trading experiences. He is also a financial industry veteran with over 15 years of experience. Gavin, please say hi.
Yes, hi everybody. Thank you, Ethan. Very happy to be here. Look forward to contributing more later in the discussion. Thank you.
Awesome. Okay. Next up, we have Mr. Desmond Leong, right? Mr. Desmond Leong is the co-founder and CEO of Everest Fortune Group. So Desmond he heads the award-winning research firm Everest Fortune Group, and they're actually the finalists in the 2019, 2020, and 2021 Best FX Research and Best Equity Research by prestigious Technical Analyst Awards. So previously, Investing Note has also worked with Desmond on multiple seminars and talks as well. So Desmond, please say hi.
Hey everyone, thanks for tuning in this morning.
Awesome. So last but not least, we have Mr. Thomas Poh, founder and managing director at PZH Consultants. Thomas is the founder and managing director of PZH Consultants, and he is an accredited trainer in the financial market products, where he partners with leading universities and financial institutions, including CME Group, National Technological University of Singapore, NTU, and Singapore Management University, SMU. He is also a transformation management consultant to corporations and a professional member of the Asia Professional Speakers Singapore, right? And Thomas has over 20 years of experience in the financial markets with trading, right? So Thomas, you want to say hi?
Hey, morning, everybody. Thanks for signing in early on a Saturday morning. Okay, look forward to sharing with you, everybody on the panel.
Awesome. So let's move on. Okay, before we start this entire summit, right? Do take note that, of course, we have a disclaimer, and whatever we present here and whatever the speakers say, it's only for your educational purposes. Okay. Let's move on. So of course, right now we're at the keynote panel, and we are looking at these 4 grand main themes that are very pertinent to every investor and trader out there. Of course, there's inflation, there's risk, there's transition, and there's growth, right? So, of course, today we are looking at these 4 grand themes, and if you have any questions, please put it in the comments below, all right? When you're seeing in the Hey Summit page. Okay, let's move on. All right, so let's get the ball rolling, right? Of course, we know that the major US indices, DJI, S&P 500, and NASDAQ actually have reached an all-time high, right? So they actually this all-time high has actually been led by most of the big cap stocks, right? But I think a lot of those small cap and those mid cap stocks have been experiencing massive volatility so far. So I think the key questions on most investors and traders' mind is this volatility a call for concern as risk, or is this an indication of opportunity? The idealists will say that the glass is only half full, right? The people who are the pessimists will say that the glass is half empty, or is it the other way around, right? Okay, let's move on. Okay, so I think the first theme we're going to talk about in this keynote presentation is inflation, right? First question, right? So every investor and trader cannot run away from this theme, right? The spike in inflation. So can we have some insights from the panelists on the Fed rate hike probability? And FOMC meeting just happened 2 days ago. So I'd like to ask the floor, what are these insights they can share with our audiences?
Okay, Ethan, thanks for that. Maybe I'll kickstart first. Okay, awesome. Before I start, I like the way you put it in terms of looking at it, whether it's a risk opportunity. Actually, risk and opportunity are both sides of the same coin. So it depends how do we manage and basically harness these risk events into opportunities. So if you talk about inflation, right, let's take a step back and really look at what are the causes of this spike in inflation. Okay, of course, we have the QE to infinity that happened in 2020. And actually that was the event that saved the entire global markets from falling into the abyss. And then we have the COVID resultant supply bottlenecks, okay? And also the big rebound in terms of consumer spending in general, post-lockdown. Okay, so looking at the market pricing in terms of FOMC rate hikes scenarios, post last week's FOMC meeting, the market actually priced in about 2 hikes, okay? 2 hikes in 2023, with a 50-50 chance that the first hike most probably will happen end of 2022. Okay, that said, if you have been monitoring, you have been watching the chairman's press conference, all right, okay, and the minutes and what they have announced, basically the Fed is going to be very data dependent. Okay, they see that inflation is going to be transitory. Okay, especially with this Delta variant new development. Okay, and also, okay, we have to keep in our mind that the Fed themselves have announced a shift into a so-called new policy framework back on the 27th August 2020 last year. Okay, so basically they are targeting average inflation. Okay, which means that the Fed has openly said that they're going to err on the side of caution. Okay, by letting inflation potentially run longer. Okay, rather than hike prematurely. Okay, so given the current data trend, okay, I'm in the camp that inflation is going to be transitory and we should see hikes not earlier than 2023. I do not see it happening in 2022. Okay, market is 50-50 on that for one hike at the end. That said, I think what we really have to watch is less of the rate hike probability, but the timing. Okay, the potential timing in terms of announcement of the Fed withdrawing of the asset purchases or actually reducing, we call it the tapering. Okay, currently is buying about 120 billion monthly asset, 80 in treasuries, 40 in mortgage-backed security. So basically, I think that is the thing we have to watch first. Okay, and the market is actually scrutinizing the Fed's language, their public speeches. Okay, and in turn, the Fed is looking at key things like employment figures, the GDP growth recovery, inflation, and of course, developments in the Delta variant. Yeah.
Actually, Gavin here. I'd like to add on what Thomas has shared. Totally agree on what he has shared, but just a little bit more sharing over here. On the 28th of July, 2021, actually the FOMC kept interest rates in a target range between 0 to 0.25%. So, if you talk about certain things that we can look for is investors will need to look for clues if, like what Thomas has shared, the monthly bond purchase of 120 billion a month might start to pull back. So these are all indicators. But just a little bit of sharing on the inflation portion over here. Yes, I mean, by keeping interest rate low, the thing about inflation, this big thing has came up because consumer prices has been running higher since before the financial crisis of 2008, meaning to say is that things got more expensive. But when I look at the information, when I look into the data, actually I start to realize that the inflation was contributed mainly from used car and truck prices. They are the one who actually climbs the highest, over here. And I think for the past 12 months, it was around 30%. Of course, in terms of some of the, in terms of commodities, I think in terms of gas, it has also went up in terms of around that percentage around that period. But interestingly, when we talk about inflation, something to take note, food prices has remained competitively tame. It's only up 2.2% for past 12-month period, as what I received. So this is something that it will be good sharing. If we look in depth, a lot of times when we talk about inflation will be our very basic commodities like food. But if you look at it, food prices has been kept quite relatively low over here.
Thanks, Gavin, for sharing. Other panelists?
Yes,
Thoughts?
Yeah, I would just like to chip in and just echo, what Thomas and Gavin said. First we need to understand, what is the Fed's reason to want to hike interest rate, right? There is actually, a runaway inflation caused by overheating economy. So it's just to curb that runaway inflation. So again, how we position ourselves at CSOP is that we ask ourselves two questions, right? Is the US economy growing through a strong phase of economic growth right now? Our answer to that is actually yes, they are recovering, but very fragile due to the existing risks, such as the persistence of the COVID-19 and its variants. The recent inflation in figures, right? Inflation numbers. What caused the spike? Is it transitory or is it here to stay? So again, the answer to that question is that the huge stimulus package, just like what Thomas said, is to support the economy globally, to save jobs. We just have to agree again, we believe that huge inflation will be transitory. But the question is, what's next after the aid is being used up? We have not yet controlled the virus globally. Without a concerted global effort to tackle this virus, I think we're going to experience, frequent lockdown disruption to both supply and demand chain. And we believe, the basic inflation, the smaller inflation would be here to stay. Big inflation definitely would be a transitory. So looking at the COVID-19 situation right now, I think the market is pricing in interest rate hike, probably like in early 2023. That's a very optimistic situation based on the COVID right now. Anything earlier would be dangerous. And I think the best case scenario for our view is that, mid or probably even end of 2023, just to put it out there. On the tapering, again, have to take cue from, the two data, inflation and also with employment as well within US and of course globally. So again, these two data circles back to how well US economy is doing, and is it an organic growth for US in that sense. So one key event we should probably take a look at is actually the Jackson Hole in August. That's actually one of the major events we should actually focus whether there's any clues coming out from there will be a tapering in that sense. Thank you, Ethan.
Awesome.
Yep.
Awesome. Any panelists, any other insights to share? Because we are, next year is already 2022, and if Thomas earlier he said that if it's very early 2023 or maybe even the end of 2022. So technically, if it's the end of 2022, it's just next year. It's pretty fast on that. All right, so let's move on. Right. So I think that the second question that we have is, in spite of the heightened fears of inflation accelerating, right? We also look at the US Treasury yields, right? So they have actually hit 1.7% earlier this year. Of course, there's right now it's about 1.2%. So I'd like to ask the panel of speakers here, how should retail investors interpret this move?
Okay, I think maybe for some of the audience, maybe it's not too familiar with the bond market. I think we have to clarify that bond prices have a negative correlation with yield. So as bond rallies, yields drops. So what Ethan you have said is interesting because the 10-year US Treasury yield has spiked above 1.7. It went to 1.77 in fact at the high. And then it crashed all the way down to 1.12 after that. And that was only a couple of weeks back. This market phenomenon actually had the entire global market scratching its head, okay, including the Fed chairman, as he mentioned during his press conference. He basically had a no clear answer when being posed with this question. Okay, my explanation is this. I think, number one, I think the market got ahead of itself in terms of the inflation trade. So that's one. And I think as markets start to realize that there is a chance that inflation can be transitory, I think people start pulling it back because to be short treasury, which means that you are expecting interest rates to go higher, is a negative carry trade. Okay, because yield curve is positive. So you actually lose money every day if the momentum stops. Okay, so that's the first one. Okay, so what actually happened is, I think post two FMC ago, the two FMC ago, when they start shifting the dot plot, okay, the market start to realize that, hey, maybe the Fed may not be behind the curve after all. When we mean behind the curve means behind their efforts to basically contain inflation. Okay, plus the realization that inflation potentially can be transitory. So that created what we call a position adjustment. So as market got ahead of itself in the big round up from less than 1% at the beginning of the year to 1.77, I think market is what we call caught short treasury. So as too many people are just loaded in the same trade, as the position adjustment kick in, so momentum kicks in. Okay, so stop losses will have gone through. Not just in directional part, but also there is this big play, what we call steepness. So the market during the run up in terms of yields was heavily into what we call the steepening trade. Basically, they are short the long end treasury and long the shorter end treasury, hoping that the long end treasury yields will go faster and higher. So when that everything unwind, okay, we have a what we call a position adjustment, which I would say is the main reason for the fast move down to below 1.2 this year.
Thanks, Thomas, for sharing. I think a lot of retail investors are also scratching their heads because I think for retail investors who actually prefer to invest in the equities market, undeniably it is also we have to actually know how the bond market and US all these treasury bonds and yields actually work. So thanks for sharing, right? Other panelists, do you have anything else to echo on Thomas's thoughts?
Yeah, definitely. Yes. So I think just to take a step back, how do investors, mass return investors and high net worth probably look at this yield, right? How should we interpret this move? That the yield of a 10-year treasury reflects an expectation of the investors. So in this sense, would be lenders. How would in two basic terms, like the yield reflects the expectation of from the lenders in terms of how the ability of the borrower, in this case, U.S. governments, can repay its debt. So it's actually, I think in this case, it's they have actually very high ability to return their debt for U.S. government. Also, next, I see the expectation of inflation, and the interest rate high. So the higher the yield, it means that lower the yield means the inflation is actually the risk of its expectation of risk is actually lower. So having said that, so we can interpret that this move is that the investors' fear of a runaway inflation and the expectation of interest rate hike actually subsided. Expect the interest rate hike. The expectation of interest rate hike definitely as lower, respectively. So I think likewise, it's actually happened in China as well. With the introduction of the 50 basis points in terms of their triple R, investors snapped out Chinese government bonds. And having said that, we saw the China 10-year yield bonds, right, coming from the high in June, about 3.1%, to just below 3% recently in July. So you could see that, the expectation of inflation, I think both globally and as well in China, has actually gone down already. Yeah.
Thank you, Adrian, for sharing. I think that's very insightful when you, sort of bring in the insights from the East as well, right?
Thank you.
So let's move on to the next question. Okay, so I think the next question for most of the audiences right now are, what are some of the key inflation indicators that investors should look out for? Other than just, the commonly used ones, which is the consumer price index or, your producer price index. Panelists, do you have any things to share?
That's when you please.
For me, I think just kickstart off this range of inflation indicators. I think one of the things that we should be looking at is definitely higher oil prices, commodity prices like lumber, copper, iron ore, kind of used in construction and other stuff. But more importantly, right, is this kind of things that it increases the cost due to the supply chain bottlenecks. One key question that I think is we need to consider is whether corporations will kind of pass on these costs to the consumer. As I personally don't think companies have, and at least at this stage, right, they have a lot of pricing power during recovery. So this tends, especially we are talking about this broader theme of inflation, right? I think that this tends to hold inflation at bay, on the consumer reading, right? So this is one of the things that I think, at least kicking off this discussion, I'd like to start off with. Yeah.
Thanks, Desmond. Thomas and Adrian?
Okay.
Sorry, Thomas, yes.
Yes.
Thomas, you can go first. Yeah.
Okay, sure. I think, Desmond, thanks for sharing. For me, I think I just add a couple. I think most of the indicators you have mentioned, oil, CPI, PPI, a couple of indicators to really feel the pulse of the inflation situation. One, I would recommend everybody take a look is what we call the US break-even inflation rates. Okay, so this is an index basically calculated by subtracting the real yield of inflation-linked treasury. So in the US treasury market, there's this set of assets called inflation-linked treasuries. Okay, so you subtract the real yield from the actual US Treasury yields. Okay, so the difference basically is what the market tells us their expectations of inflation for the particular tenor. For example, the 10-year break even now is around 2.4%. So the market is saying that the inflation in 10 years down the road is around 2.4%. So that's something worth looking if you have not been looking at that. The other one, okay, besides checking the prices of the commodities, we can also check the activities in terms of shipping these commodities. And to look at that, there's this index called the Baltic Dry Index. Okay, so the Baltic Dry Index is basically the tracks the iron ore and coal cargoes, 15,000 tons and above. Okay, so there is this index, and right now is hovering around the highs. Okay, so these are what I call leading indicators. Okay, leading indicators. Okay, so this is something that I would recommend the audience to take a look.
Thanks, Thomas. Adrian.
Yes, I just want to echo what Desmond has actually mentioned. Like, right now the producers are actually having the bargaining power. They have not passed on to, the cost to the consumer. And I think in China, we see that, PPI has actually run up, but hasn't been transferred to the CPI within that country right now. And, rightly so, we take cues in terms of how we structured and how we position our reports to investors, is that we probably take a look at basic commodity price like oil and copper. And what we saw that we observe copper usually run up first before oil. And that's actually the leading indicator for ourselves, a leading indicator and one of the reliable indicator into seeing whether inflation is actually coming. So we usually take cue from copper prices. Then after that, we back it up with oil prices as well. And I think right now, again, just to echo Gavin right at the start, food prices such as pork has actually been at a low price or has been at a sustained price due to China have been letting out reserve in terms of pork. So I think consumer CPI within China is still very, very low and decoupled from the PPI. Thank you.
Awesome. Thanks for sharing, Adrian, Desmond, and Thomas. All right. So I think our panelists actually shared a lot of things on the theme of inflation. So let's move on to the second theme, right, which is risk, right? So of course, the first thing when we talk about risk that comes to mind, right, is actually this COVID-19 Delta variant. There is currently a resurgence globally. So we've seen not just in Singapore, but other countries as well, like the US, Vietnam, or even in China, there's a couple of cases where it's been detected, right? So I would like to ask the panel of speakers, where do the headwinds lie?
So I'll take this. I'll lead in
Sure.
this question right now.
Sure, Adrian.
Yeah. So Delta, COVID-19 is a pandemic, and right now as in the history of human mankind, we have actually gone through pandemics as well, and it now become a endemic right now. We have a HIV endemic, we have a Ebola, right, and epidemic right now, right? I think for us right now we learn how learn more about this COVID-19 virus and its variant. We will soon learn faster. We'll learn to live with it, and we believe in our view, CSOP views, that we believe COVID-19 and the Delta variant is and still would be a greatest risk right now in the near future, and probably drag out in the longer term. So a good example is actually SARS. We're experiencing the height of it within in Hong Kong and within the region for 3 months, and it took us 3 years to recover. So right now we have been dragging more than a year, and I think we're going to learn how to live with it, and we probably have to see the recovery build up over a longer period of time. So earlier this year, Guangdong had an outbreak. We saw the PMIs, both manufacturing and non-manufacturing for China, gone down due to a lockdown right there. 2 days ago, it's reported that Nanjing Airport has a new cluster with the Delta variant. And then, certain other 2 provinces as well, somewhere near Myanmar as well, the borders, they detected that there's an outbreak in Myanmar as well. Like rightly say, so Vietnam had factories closed, such as Nike factories closed due to a resurgence in the COVID-19, and that would definitely, cause a lot of disruption to the supply chain, and having said that, that potential, all these disruptions potentially would cause the inflation kind of thing, because you're hampering the supply chain. I think next also another one is actually the tug war between governments over data. I think that's the next most precious commodity right now. Besides, last time was oil, but I think right now data is actually a very precious commodities. So governments trying to secure these commodities. We observe a bit of heightened in terms of regulatory scrutiny by regulators, both the major powers. So I think to summarize, for start, so COVID-19 a health risk right now. That's where it lies. I think right now at this junction, I think regulatory risk is actually something that we need to take a look as well.
Thanks, Adrian, for sharing.
Yep.
Right, I would agree, definitely. Other panelists, do you guys have any insights on this?
Yeah, sure.
Actually, Ethan, Adrian, I have a slightly contrarian view in terms of that.
Sure.
No doubt, I think this Delta variant, from a health point of view, is very concerning. I think in terms of how the various countries is addressing and how, or their lack of ability to address effectively this re-emergence, this Delta variant, I think it's a very big issue, okay? I do not deny that. But that said, how does this actually translate to, say, weakness in the market? I think the market, after having gone through 2020, okay, having seen the abyss and how the shock and awe of this outbreak, I think is a lot lesser. Plus, I think governments are already putting in place measures. And most importantly, I would say that besides the fact that I think the COVID, where we have the vaccine and the government's lockdown sort of slowing down the spread, the market is actually buoyant because of what? Because of liquidity. Okay? And ironically, with this Delta variant, that is the biggest reason the Fed have to err on caution. So whether we like it or not, the irony is this: with this Delta variant, the Fed will have, basically their hands are relatively tight because they have to really see how this is transit. And the market will continue be buoyant because of the presence of the liquidity, the fact that the central bank balance sheet, not just on the Fed, the ECB, the BOJ, and that will translate into markets continue to grind higher, in my humble opinion. So there is this a conflict in that sense, okay? Because of this Delta variant, okay? It will have its impact in terms of the economy, don't get me wrong. But, and we will talk about this later, but the market in general is making that transition, okay? As countries become adaptable, as we move from pandemic to endemic, all right? The market itself have also, more or less taken it in its stride, rightly or wrongly so, but that is exactly what I'm observing.
Thanks, Thomas, for sharing this. I think you made a few very good points there as well. All right. Do any panelists want to add on anything?
Yeah, sure.
Gavin?
Yes,
sure.
Okay. Yeah, I mean, thanks everybody. I mean, actually, I'm totally in line with what Thomas was sharing. If you all look at this resurgence in terms of this Delta variants, I mean, surely everybody will have fear. I mean, especially if you look at since last November, we have this vaccine breakthrough. And just to add on, when Adrian was introducing himself, he got his first shot. I got mine yesterday on the second shot. So, but there were talks about, because of these Delta variants, booster is required. So, if you look at some of the statistics, especially in Israel, where they are the first few countries who took Pfizer, it seems that, that there is an increase in terms of people getting COVID. And, what they have previously, or what they got most of the population to be vaccinated, seems to be, with this Delta variants, it seems to be less and less effective. So maybe just to share a little bit more on the statistics, there are countries, there are developed countries where vaccination rates are relatively high. So, take example, you take for Britain. It's a good 69% as of 30th of July. So you are talking about for every 10%, you have around seven people who are being vaccinated. But you see, the thing is, if you look at statistics, the troubling part, and is that despite you have this high vaccinations rate, it seems to, with this introduction of this Delta variant, there is a failure to severe or even to weaken the link between this infection. That's how I'm looking at it. And what's more, if you look at countries who does not have, have not even received the vaccine, or even the Pfizer's, or even the different, medication right now. What's more, you can talk about those countries. So how I look at it is, it really depends on, right now, if you look at it with this introduction of this Delta variants, this re-emergence of this Delta variants, how I feel is, in terms of government policies, it will be very different as compared to if you look at, where a lot of times where, if you look at many years ago, it's always US taking the lead, or we look at, China, but, now, a lot of governments are stepping in, because for political reasons, because for many reasons, everybody are looking. So how I see it is, things, it really got to depends on different countries, and things will be very different. And of course, this does not help with the current relationship between US and China. So how I look at it is, with this, that there will be a lot of, in terms of, different recovery in different countries. That's how I look at it.
Yeah, it's I would agree. It becomes more unpredictable in that sense, especially when the virus is practically invisible. Right. Okay. Let's move. Does anybody have Desmond? You were saying something?
I just wanted to touch really quickly on one point, which I think Gavin made a raise, which was the focus is on England, right? Because personally, I think we're talking about all these different countries, right? And if we are from a retail trader audience point of view, if you want to focus on one country, I think it should be England, because you think about it, the number of new daily cases, is actually down 21% from last week's peak. And the reason why I think we should focus on England is for two reasons, right? Firstly, I think it's the key country to watch in gauging whether global risk sentiment improves in response to the Delta variant. Because if you think about it, it's kind of at the vanguard of trying to break the link between new COVID cases and overrunning hospital capacity, right? And the good news to this is that numbers are currently on the UK side, where new hospital cases, they are remaining relatively low, to new COVID cases. So this matters a lot for those countries who are looking for a way out, right? And this growing evidence that the UK is, actually breaking the link between these new cases and hospitalization, I think it can be viewed as a very bright light, at the end of a tunnel for many of these vaccinated countries. And from a personal point of view, right, I think it light a fire under, the policy markets, where vaccinations are dragging a little bit more. So yeah, long story short, I think if anything, we kind of monitor, UK Freedom Day, all that stuff, monitor it a little bit more.
Yeah.
Right? It gives us very good insight into, it's like Vanguard's like the test, whether, can we really exist? Can we have the Singapore Freedom Day, so to speak? Yeah.
Very good eye there, Desmond. Thank you for sharing. Okay, let's move on, right? So earlier, Adrian was talking about the, this global regulatory scrutiny. So I think right now, other than the COVID pandemic, there's also this regulatory scrutiny where, countries are using data as, these prized possessions. So, panelists, can you let the audience know what's the current state of things?
Okay, let me jump in right now. So,
Sure.
just to have a bit of history, like how this all happens. Actually, in our view, is that it started from the U.S. trade tensions, U.S.-China trade tensions, trade war started by, in our view, started by Donald Trump, has spurred China to be more independent from external forces. In its recent 14th five-year plan, they coined a theory. They want to have a dual circulation theory, right, where they want to boost domestic consumption via their homegrown technology firms. But in the past, Chinese regulators always have adopted a very light touch to these tech firms. All these have changed by this guy called Jack. The scrutiny, went from tech stocks to educational stocks. A rumor that was spread in July 23rd. They want these educational companies to be non-profitable kind of thing. Massive sell-off happened. Both global and domestic investors start to dump and start fleeing from the Chinese markets, right? But the thing is actually, China's regulatory scrutiny or regulatory oversight has always been there. It has actually happened in 2017, with the clampdown with the peer-to-peer lending. And that happened in 2017, but there was actually not much of a hype, back then. But right now, it's actually widely discussed, among investors right now, because we are more invested into China, into tech firms, Chinese tech firms, due to the story that we believe that China was the first in and first out. We went to invest into that country, due to its fast recovery and due to the popular team. The new teams that came out from the COVID-19, such as technology would actually help us to overcome the obstacles of physical lack of physical meetings, adopt technology to help us in terms of our daily life needs, right? So and then however, just 2 days ago, the China Securities Regulatory Commission set up a very fast, a very hastily put up virtual meeting and said inform the market participants and banks, let's not overinterpret our actions or their actions, having to say that right now, what they need to do is actually to regain investors' confidence, and the vice chairman did notify during their virtual meeting that they will roll up official policies. Do not listen to rumors, and this is actually to help to reduce market volatility. So in summary, China is actually a socialist country. China is actually acting as a steward to its citizens. However, having said that, they also need the Chinese tech firms, for their plan in a 14th five-year plan, right? So they are actually doing a very delicate balance right now in terms of being a steward to its citizens, yet having growth and to execute their 14th five-year plan. So in the summarized long-term view, right? Always do take a long-term view in terms of the market, and we believe that this will definitely pass eventually in the future as well.
Thank you, Adrian, for sharing.
Yep.
Panelists, other panelists, do you have any insights on this?
I totally agree with Adrian. I think what has transpired over the last 1-2 weeks so far, especially in the China tech stock space, I think it's growing pains. Okay, as the regulators trying to balance the various interests, I think they are also learning in terms of the impact of the way announcement has been made. Okay, if you really look back, 2000 in the stock market crash in I think 2015, okay, they also have learned their lessons in terms of circuit breakers and stuff like that. So in the long run, I think is progress in the right direction. It's not a straight path. Okay, at the end of the day, I think people forget China is an emerging market, and the China financial market is what, 20 years old? If you really start looking back from liberalization, okay? If you look at the US financial market, all right, the number of trial and tribulations that you have gone through since 1900s, I think US is more than its fair share. So I think if you want to invest in the China growth story, remember it's an EM market. Remember that you really have to have a longer term view, and to me, these are opportunities. Yeah.
Thank you, Thomas, for sharing. I think you sort of sum up this regulatory scrutiny thing that is affecting a lot of this investors and stocks globally as well. So let's move on, right? So what comes after risk, which is transition and growth? Where do the opportunities lie, right? So let's move on to the next question. right? So in the global equity markets, where are the opportunities today and what are the key trends ahead? Open to the floor.
Maybe I will just kickstart this on
Sure.
in terms of a key trend. Of course, on our side, based on our data, we are seeing a lot of very young tech-savvy investors. Some of them, most of us will call them the Gen Z or even the millennials. I got to say, they have started trading, and on our side, we are exponentially seeing an increase in the number of people who are actually opening an account. I got to say, this mainly contribute in terms of the education that they have. I got to say, I think I said a few times, those educations or those causes that those younger groups or Gen Z people that are exposing right now does not exist 15, 20 years ago. Example, you talk about those big data, you talk about encouraging to go into financial seminars, courses, or even the certifications on that. I got to say, 15, 20 years ago, those are very rare. Or even if you want to go, you got to pay a huge sum into that. So we are actually seeing, a big group of these young tech-savvy investors coming in, and surprisingly, they are not, in terms of, unlike, where they needs a lot of help, where in Singapore, we will call it the remisers, a lot of them are actually doing sell trading. So, as much as a lot of them may be very new with their educations, which give them, a strong foundation. I think there are people on our side where we have those community. What we observe is there's a lot of sharing by this group of young people, and for older group of people, including me myself, I also learn a lot. And there's a lot of sharing, and with this sharing, or even surprisingly, even when they, there's always on my generation, there's always, win money then talk, then share. If you lose money, don't tell anyone. But you see, surprisingly, whether they are winning or losing money, you will see them posting out their results and sharing what should everybody know or learn from them. So this is where what we realize in terms of the key trend, and how we are seeing. Of course, we foresee in future, in very near future, they may form the backbone of this trading community. Given that if you look at some of how US, some of the stocks was moving, and if you all look at it, it's no longer the institutional power. It's a lot of time retail power coming in, whether to move the stock up or down. Of course, in terms of opportunities today, I foresee there's more and more, in terms of products out in the market, cryptocurrency. Those days where my mom asked me to work as hard as possible, so that we can earn more money. But it seems that right now, how the trend that I'm observing is with this cryptocurrency trading, and those people who may have cryptocurrency that they bought in 2010, they are either million or billionaires right now if they are holding on to those. So, and if you look at the age right now, they are so much younger, and the transfer of wealth, that how we are looking at over here, is no longer as as the same as what we are seeing many years ago. So how is this? For sure, there's many different products out there, or even you talk about ETFs, or even futures, options, stocks. So there are so many products out there, and it's all you can find in a single platform like Moomoo itself. So how we look at it is that there surely will be many trading opportunities. It's just that my recommendation will be looking into something that will value add in terms of your trading investment journey.
Thanks, Gavin, for sharing. I think I would like to attest to that as well, because Investing Note, we run the first and the largest community in Singapore, and we have a community of Malaysian users as well. So I think right now, technology has empowered a lot of these investors, the mom and pop investors, to actually, start to rise up and speak up. So it causes a bit more of those trading liquidity as well. I think, Gavin, you can see from the data, probably in the Moomoo app, that this is translated to market activity, right?
Yes, correct. Ethan, totally agree. Whatever that nowadays how I mean the younger people, I got to say, they are very direct. I mean, and with the access of trading apps, one-stop apps, the easy access, and things are getting very vibrant. And of course, with this pandemic, where most people are working from home, so they are thinking that why not spend a little bit of time in trading also.
Thanks, Gavin, for sharing. So, panelists, anything else to add for this in terms of opportunities? Adrian, perhaps?
Yes, thank you. So I'll keep it really short. I think we take clues. We take clues from observations, right? I think just to echo Thomas, like crisis always offers opportunities. Yes. So we can take cues from even from the government's direction, such as China's 5-year plan. So I think right now what we see from the news is actually climate change, heat wave in Canada, flood in China, coupled with the Chinese governments or even international governments trying to be carbon neutral in the next decade, right? So or the next century. Having said that, US targets to be neutral by 2050, China carbon neutrality goal by 2060. So we could probably look at investment opportunities to ESG and renewable energy. Having said that, this climate change will definitely disrupt our food source. We probably can look at some investments into sustainable food sources, things like that. Next one is actually, with the COVID-19 viruses outbreak, definitely will continue to, be a hard stop kind of thing. So aging population as well. So probably healthcare, biotech, technology innovation is actually some of the broad theme that we can actually have and probably offer some opportunities for the investors going forward.
I believe Adrian will have an individual speaking slot later where you share in depth on where the opportunities and where the headwinds lies as well.
Thank
All right.
you.
So
Yes.
I think we're a little bit short on time. Let's move on to the next question. Right. So let's take a look at the technological evolution, and just now earlier Adrian actually mentioned focus on ESG, right? Environmental, social, and governance, right? So how can investors ride on this trend? Perhaps maybe Desmond or Adrian or the panel, anybody can actually give us some insights on what you guys think.
Oh, Desmond, are you? Do you want to take this?
You go ahead first.
Okay. Okay. How to play this? It really depends on the individual investments. Like we observe there's actually a growing adoption from mass and high net worth investors into ETF. And why ETF? It's because it's very simple to understand. It's very transparent in terms of pricing and in terms of what the ETF is actually tracking and its investment objective. So, take for example, a Hang Seng Tech Index is actually just inform the investors that the number of stocks that's within the index, what type of stocks qualified to be included in terms of market liquidity, market cap, and relevant sectors. It also tell investors very transparently that what's the special features like the fast entry rule. And I think most, how could we play into such teams is actually ETF is because it also give you diversification. And I think it's the only free lunch in the financial world right now. Eliminate single stock exposure if you don't have time to do in-depth fundamental analysis and the risk of your investment being zero. So this is my potential play of how investors can actually play into these different teams.
Thanks, Adrian. Desmond, do you want to share something?
I got nothing much to share. This are usually very similar to Adrian. I buy the index. Right?
I think the good thing about this ETFs, right, is that it's thematic. If you're looking at growth in the EV sector, but you don't want to have that kind of non-diversified risk, right? Probably you can actually look at the ETFs, which have probably EVs inside as well, right? So I think this is probably a very good insight that Adrian has shared, right? So we got probably 1 minute left. So before we end off this session, right? I would like to ask our panelists, do you guys, if you have one advice for investors, what would it be right now?
Thomas, you're muted.
You're muted.
Okay, maybe just let me kickstart on this. While we all welcome the empowerment gained by the retail sector regarding to this trading revolution, right? I think word of caution here. Okay, there are drawbacks. We have to be careful of leverage. Leverage is a good servant but very bad masters. And in particular, I think we have to be careful of meme stocks. Okay. As much as we are leveraged and we would like to go with momentum, all right, be careful because a lot of this meme stock is not backed by fundamentals. Okay, and I written an article on this called "Careful While Going to the Moon." Okay, as we get to the moon, we'll realize that it's actually a cold and lonely place there. Okay, so do not be Johnny come late. Do your risk management. Okay, bubbles will occur all the time, and it occurs all the time. So we just have to watch your risk management there.
Agree.
Panelists, yeah, sure.
Yes, Gavin here. So just to add on, I think one advice I will use is to diversify. I mean, if you look at one observation is US stocks and international stocks, they are not moving in sync with each other. So this underscores the more importance in terms of global diversification. And what's more, I think we shared that, in terms of the recovery growth of different countries will be very different. So it really depends, so to me, diversifications surely will smooth in terms of the volatility as a market swings, front and back or up and down. So to me, build a diversified portfolio, based on the tolerance of your risk, rebalance your portfolio regularly. I mean, ignore the noise. I mean, I know there's a lot of news out there, everybody say, trade into crypto, but that's really depends on your horizon. You're talking about 3 years, 5 years, 20 years. Ignore the noise. I mean, just build a diversified portfolio. And from there, just rebalance accordingly. And of course, last thing is, after sharing all this, this is where a Momo account will be able to help you. That's all.
Awesome. So I think very good sharing by all the panelists. Right now we are a little bit short on time. We don't have the time to actually go through the questions from the audience. But if you have anything, you can always reach out to us as Investing Note, right? So we're gonna start the next session really quickly, which is the 10 nifty things investors can use on the Momo app for free, as presented by Josh, who is the business development manager there. So with that, I thank all the panelists for your time in sharing. And it was a very great sharing session. We are so short on time, we didn't even have the time to take questions from the floor. But if you liked more in-depth information that each of our panelist speakers will be sharing, please tune in all the way from now to the end of until 1 p.m. All right. So there'll be ongoing sessions back to back. So it's a very exciting schedule lineup for you guys. So with that, I'll see you in the next session. Right. Thank you.
Thank you. Have a nice weekend.
Thank you.